Hey guys, welcome back to the channel. So today we're going to talk about hedge funds. We talked about mutual funds, now we're going to talk about hedge funds, right? So, what is a hedge fund? Well, hedge funds are alternative investments using pooled funds that employ different strategies to earn active returns, or alpha, for their investors. Hedge funds may be aggressively managed or make use of derivatives and leverage in both domestic and international markets with the goal of generating high returns, either in an absolute sense or over a specified market benchmark. So it's important to note that hedge funds are generally only accessible to what's called accredited investors, as they require less SEC regulations than other funds. One aspect that has set the hedge fund industry apart is the fact that hedge funds face less regulation than mutual funds and other investment vehicles. So let's try to understand hedge funds, right? Each hedge fund is constructed to take advantage of certain identifiable market opportunities. Hedge funds use different investment strategies and thus are often classified according to investment style. There is substantial diversity in risk attributes and investments among styles. Legally, hedge funds are most often set up as private investment limited partnerships that are open to a limited number of accredited investors and require a large initial minimum investment. Investment in hedge funds are illiquid, as they often require investors to keep their money in the fund for at least 1 year. This time is usually known as the lockup period. Withdrawals may also only happen at certain intervals, such as quarterly or biannually. So, let's talk about some key characteristics of some hedge funds here. They're only open to what's called accredited or qualified investor. Hedge funds are only allowed to take money from qualified investors, which are individuals with an annual income that exceeds $200,000 for the past 2 years, or a net worth exceeding $1 million, excluding their primary residence. As such, the SEC, or the Securities and Exchange Commission, deems qualified investors suitable enough to handle the potential risks that come from a wider investment mandate. They offer wider investment latitude than other funds, right? So a hedge fund's investment universe is limited only by its mandate. A hedge fund can basically invest in anything: land, real estate, stocks, derivative, and even currencies. Mutual funds, on the other hand, right, have to basically stick to stocks or bonds and are usually long only. So what else, right? So they often employ leverage, right? Hedge funds will often use borrowed money to amplify their returns and also allow them to take aggressive short positions, depending on the fund strategy. Back in 2008 during the financial crisis, we also saw that leverage can also wipe out hedge funds, right? Just absolutely wreck them. There's a 2 and 20 fee structure. Instead of charging an expense ratio only, hedge funds charge both an expense ratio and a performance fee. The fee structure is known as 2 and 20, a 2% asset management fee, and then a 20% cut of any gains generated, right? So, let's talk about how to pick a hedge fund, right? With so many hedge funds in the investment universe, it's important that investments or investors know what they're looking for in order to streamline all the due diligence and make timely and appropriate decisions. When looking for a high-quality hedge fund, it's important for an investor to identify the metrics that are important to them and the results required for each. These guidelines can be based on absolute values, such as returns that exceed 20% per year over the previous 5 years, or they can be relative, such as the top 5 highest performing funds in a particular category, right? So let's talk about fund absolute performance guidelines, right? So, the first guideline investors should set when you're looking for a fund is the annualized rate of return. Let's say that we want to find funds with a 5-year annualized return that exceeds the return of, let's pick Citigroup World Government Bond Index by 1%. This filter would eliminate all funds that underperform the index over long time periods, and it could be adjusted based on the performance of the index over time. So this guideline will also reveal funds with much higher expected returns, such as global macro funds, long biased, long short funds, and there's a bunch of others ones. But if these aren't the types of funds you're looking for, then they must also establish a guideline for standard deviation. Once again, we're going to use the Citigroup World Government Bond Index to calculate the standard deviation for the index over the previous 5 years. And we're going to assume we add 1% to this result and establish that value as the guideline for standard deviation. Funds with a standard deviation greater than the guideline can also be eliminated from further consideration. So a different guideline is fund relative performance. So to facilitate the investor's research or your search for high quality funds that not only meet the initial return and risk guidelines, but also meet strategy specific guidelines, the next step is to establish a set of relative guidelines. Relative performance metrics should always be based on specific categories or strategies. As an example, it would not be fair to compare a leveraged global macro fund with a market neutral long short equity fund. So to establish guidelines for a specific strategy, you can use an analytical software package such as Morningstar to first identify a universe of funds using similar strategies. Then a peer analysis will reveal many statistics broken down into quartiles or deciles for that universe, right? Let's talk about some other guidelines, right? An investor may also want to consider, a bunch of other stuff that can either further reduce the number of funds to analyze or to identify funds that meet additional criteria that may be relevant to you. Some examples of these other guidelines would be like fund size, right, or firm size, a track record, minimum investment, and like the redemption terms, right? So, tax hedging fund profits, right? When a domestic U.S. hedge fund returns profits to its investors, the money is subject to capital gains tax. The short-term capital gains rate applies to profits on investments held for less than 1 year, and it is the same as the investor's tax rate on ordinary income. For investments held for more than 1 year, the rate is not more than 15% for most taxpayers, but it can go as high as 20% in high tax brackets. This tax applies to both U.S. and foreign investors. An offshore hedge fund is established outside of the United States, usually in a low tax or tax-free country. It accepts investments from foreign investors and tax-exempt U.S. entities. These investors do not incur any U.S. tax liability on the distributed profits. So we can talk about some ways that hedge funds avoid taxes, like the way they're structured to take advantage of carried interest, right? And under that structure, a hedge fund is treated as a partnership. The founders and fund managers are the general partners, while the investors are the limited partners. The founders also own the management company that runs the hedge fund. The managers earn the 20% performance fee of the carried interest as a general partner of the fund. Hedge fund managers are compensated with this carried interest. Their income from the fund is taxed as a return on investments as opposed to a salary or compensation for services rendered. The incentive fee is taxed at the long-term capital gains tax of 20% as opposed to ordinary income tax rates, where the top rate, I think, is 39. It's 39 point something, 5, 6. It's like that, 39.5 or 6, and that represents, you got to think it's not like almost a 20% difference, right? You're saving a bunch of money, right? So it really comes down to, what kind of strategy you want, finding the right, company as far as how they're investing, what they're investing in, how aggressive do you want to be. And I do realize this video is not for everyone, right? Because you need to be making $200,000 a year or you need to have a net worth of $1 million, right? Excluding your primary residence. And if you don't know how to find out your net worth, I previously did a video on that. So you can go back and watch that video and figure out how to do that. I hope you guys liked this video. If you did, go ahead and hit that like button, share, and subscribe. I hope to see you guys in the next video. And until then, y'all be safe.